Tell me again, there's no recession. It's crazy, man. So just mind my own business, sending off an email right here. Word about your job. This is my blog post, which we'll dive into in just a second. These are the advertisers who advertise on Old Heritage Wealth Planning. I don't know who these people are, what it is, but click on it so I can get that sweet, sweet advertising money. So here's my man Brian Westbury over at First Trust Advisors. Retail sales declined. Let's just read the. Hold on, let me pause it. Retail sales declined 1% in March. Lagging consensus of only 0.5%. Retail sales are up by 3% a year ago. Let me, for the 1,000th time. Remember, if you're selling widgets, this is freaking huge, dude. And this is, I'm telling you, I don't know what to tell you, man. All I know is if you're selling widgets, say you sell 10 widgets at $10 a pop, your retail sales are 100. That's what it is. 10 widgets at $10 a pop, your retail sales are 100. Now, if you sell 9 widgets at $12 a pop, I don't know what that is. 9 times 12 is what? 108. Our retail sales are up 8%, right? But there's a big fat problem in there. Right here, the number of widgets fell by 10%. Our retail sales might be up by 8, but the widgets we sold fell by 10. Yeah, it fell by 10%. That's not sustainable. The only reason it's up because the price has went up because of the cost of energy inflation. But people still say they will still say this, retail sales are up. That's showing a growing economy without looking at what goes into retail sales. So now it's even worse. Now we got retail sales going down 1%. Sales excluding autos dropped 0.8%, below the consensus of 0.4%. The largest declines were for gas stations, general merchandise stores, and autos. The largest increase was for non-store retailers, internet, and mail order. All right. Implication: retail sales continue to cool in March, falling 1% after an abnormally strong period in January. That had more to do with one-off factors, seasonal adjustments, inflation, high prices, and unusually warm weather, rather than economic fundamentals. The weakness in retail sales in March was fairly widespread as 8 of the 13 categories declined. Core sales, which exclude the most, I hate when they do this, exclude the most most volatile categories, as important for estimating GDP, declined 0.2% in March. The last 12 months, retail sales are only up 2.9, the slowest year since 2020. Well, okay, whatever, man. But in spite of the weaker sales of the past 2 months, personal consumption portion of real GDP should come in strong for Q1 due to surge in sales in January as the continued improvement in service. Really? Because we look at this, personal consumption expenditures right here, real retail sales net of inflation is in negative category. So we'll see, man. And again, if it's just because it's in January, it doesn't mean it's going to not fall off in February and March, and then again into April and May. Let's see. However, we expect a strong gain in personal consumption to be a one-off event. All right. Consumers continue to face a headwind from inflation, which is fully offsetting gains in hourly pay. Meanwhile, higher inflation. Our view is that tightening in monetary policy since last year eventually deliver recession. Yeah. I tell you, man, so I'm going to do another video on what to do. I'll put the link if you want to read this. Actually, what happens when I click? I'm just no idea these people are advertising, but I just clicked on it. You got to smile there, lady. Don't be so angry all the time. Yeah. So I clicked on, so I refreshed, and I got another ad. Rosalind and free shipping, whatever that is. What was I just talking about? Here, this is the post. Word about your job, here's what to do. Because I'm telling you, when these retail sales come down, remember, personal consumption expenditures are what drives economic growth. I mean, and again, just because you're spending more for less widgets is not a sign of growth, dude. It's not. It's coming. Just be prepared. I'll do a video on how to be prepared. I mean, it's just this simple. But to sit there and, do whatever you got to do. I'll do another video on it. But anyway, it'll be interesting to see how this shakes. What the market's doing today. I haven't looked. Let's take a look. This is an indicative of a softening of the economy, and thus they're going to lower interest rates. Let's see. Yeah, markets are. Oh, it's weird. The 10-year is way up. Why would the 10-year be way up? That's weird, man. Because they should be. That's interesting because if the 10-year should be, I would think be dropping. Consider that they're certainly going to lower rates on the Fed funds rate. But again, they don't control. The Fed doesn't control the long term. Usually when the yields are up, that means the bonds are down. The price of the bonds are down, which means people are selling, not buying. Why would people be No, interesting. It's on any given day things can happen. It's just interesting. 10-year Treasury has gone from 3.38 to 3.52 in literally like 3 days' time. That's 13 basis points, 14 basis points in a couple of days. Bonds are volatile. Interesting. All right, love your thoughts. We'll see you.